2025 was the year where risk-taking got absolutely punished. If you went into altcoins, you lost the majority of your money. If you went into Bitcoin, you lost a bit less. If you went into gold, however, you made money. In this video, we're going to look back. We're going to look at what were the drivers of 2025 to try to get a gauge of where we might be headed in the next year. So here's what happened. This is the altcoin market cap in 2025. We went down by more than 40%. If instead you invested into Bitcoin, you only lost 10%. If you got into stocks, you won slightly, 13%. This is the S&P 500 relative to US money supply. And here is what happened to gold, an appreciation of 62%. So it seems like a decoupling is happening here. There used to be this big story of Bitcoin being gold 2.0, of Bitcoin being another form of self-custodied money, of being another kind of capital that's independent of confiscation, that's completely independent of the state. But it appears as if the majority of investors that get into Bitcoin just see it as another risk on investment. It's just more risky than tech stocks. It's simply only going up when everything is going up and then potentially to a higher degree. Now 2026 might look slightly different. This is a very long-term chart of gold relative to the money supply. It starts in 1959. Sometimes gold outperforms the monetary base by more than 800%. And in the worst case, if you're buying gold at the peak, it can go down by more than 90%. Now the dotted line, the horizontal line we see over here, that's the average ratio of gold relative to the money supply. So this is historically how expensive gold was. And we could regard the depressions and subsequent hype cycles just as fluctuations around what's potentially a fair value. The current gold price is roughly 66% above the long-term equilibrium. Or if you measure this from the current price to the equilibrium, there's a potential loss of 41%. And it seems like this current price level is already quite problematic. We have seen turnarounds in the past at exactly the current level. And there was only this 4-year period where we went above the current price. That was at the end of the 1970s, at the beginning of the 1980s. And so what had been a great investment in 2025 might be much more risky in 2026. I don't have a crystal ball either. I'm just looking at a long-term data, at long-term trend. And gold doesn't seem to be that cheap anymore. Yes, if everybody panics again massively, we could potentially perform another 171%. But is that the most likely scenario? I'm not so sure. Here is gold relative to the S&P 500. Very long term, it tends to slightly underperform. And that's because gold supply also increases year over year by roughly 2%. That's how much new gold hits the market. And if we stay in this long-term downward trend, there is still a bit of upside versus the S&P 500. Maybe a bit over 50%. But then the big question is, when the gold price is already that high, historically speaking, will the potential outperformance of gold relative to the stock market come from gold going up, or rather from the stock market coming down? I think the second scenario is more likely. Because it's not just gold that's expensive. Stocks are also historically expensive. This is a very, very long-term chart. It starts in 1871 and it shows the Shiller price to earnings ratio. How expensive are stocks relative to their earnings? Now, why do we have that massive rally in the price to earnings ratio? Why are stocks so expensive? It's of course because of the AI bubble, right? There's a lot of speculation around artificial intelligence, and we had a similar kind of technology-based speculation in the year 2000. We had the internet boom, the .com bubble. And so we have to ask ourselves, is there potentially a bit too much optimism in the market? I'd argue that that's potentially the case. Artificial intelligence will stay around, but the monetization of AI technology might take much, much longer than people expect. The same way how people overinvested in internet infrastructure back in the day, we now might see temporary overinvestment in AI infrastructure. And so when gold relative to the S&P 500 appreciates by 50%, this could simply just mean that the Shiller PE ratio goes down back to 20. A very similar drop to what we've seen in 2021 and 2022. And so where can we then put our money? What about silver, for example? Isn't silver a potential alternative? Silver has hit an all-time high. The current momentum is very bullish. What we see over here, that's the big squeeze in 1980. What we've got over here, that's now the silver price relative to the gold price. Again, with the same squeeze. So silver relative to gold doesn't look that expensive actually. It might still outperform a little more. Long term, it tends to underperform gold because it has more mining, there's more supply hitting the market every year. It's less stable of a form of money. But really, the issue is that the silver price, so that's now in green, versus the gold price, that's in orange, they tend to be highly correlated. So they tend to move in the same direction at the same time. It's very comparable to, say, Bitcoin and Ethereum. When Bitcoin crashes, it does take Ethereum with it. And while Ethereum in some crashes might not be hurt as much, it's still going down in US dollars. And the same thing could happen for silver. The silver-gold ratio might increase, but when gold goes down, then in US dollars, silver will also go down, maybe by less. And so there's a way still to play that game, right? We could bet on a rising silver price while betting on a falling gold price and just play this ratio and just hope that silver makes another rally, potentially in the best case by close to 200%. But it is a risky game. We do have a lot of volatility in that ratio as well. Now, it's very hard to time those trends, right? It's very hard to say when a bubble pops. Very often the market can stay irrational for longer than we can stay liquid. If we bet on falling prices and there's still enough people buying into the hype, we just continue losing. And so as an extension, it's also very hard to say what's going to happen in 2026. I'm simply just showing the ratios. What's potentially cheap? What's potentially expensive? And I do think that technology stocks are very expensive now. Check this out. This is gold relative to the NASDAQ 100. And this is when the .com bubble burst. And here gold outperformed the NASDAQ 100 by 1,400%. And while gold starts to outperform slightly again, the vast majority of the potential future outperformance is probably not coming from gold going up. It's rather going to come from technology stocks going down. This is the NASDAQ 100 relative to money supply. The .com crisis saw technology stocks contract by 85%. I don't really like doing it, but that's how the YouTube game works. That's how the algorithm works. Please give this video a like if what you've seen so far has been useful. Thank you very much. This over here, by the way, that's the global financial crisis. And Bitcoin was born over here, right? Bitcoin really never saw a larger economic contraction. So what can we do here, right? When stocks are expensive, when crypto potentially is expensive as well, when gold is expensive as well, what can we buy? The answer is we don't necessarily have to buy anything. Now, I'm not a fan of keeping cash just under the mattress, but I am a fan of taking bets where the odds are in our favor, not against us. And I do believe that the odds are against us if we now start buying up random technology stocks. Let me show you what I mean. The NASDAQ 100 the last year went up by 18.4%. And have a look at the NASDAQ 100 constituents ordered by their performance in the last year. Western Digital made most gains, but how many stocks outperformed those 18%? The answer is 39. 39 out of 100 stocks outperformed the benchmark in the last year. What about the last 5 years? Here the NASDAQ 100 roughly doubled. How many stocks did better than that doubling? The answer is 38 stocks. So there seems to be a 40-60 split. If we pick a random stock within the NASDAQ 100, we've got a 60% likelihood of underperforming, a 40% likelihood of outperforming. The majority of individual constituents in the benchmark tend to underperform. Or in other words, the median return is lower than the average return. Returns are concentrated towards a few winners. What that then in return means is that we can bet on falling prices. So when we bet on falling prices of something, we've got the odds in our favor. Then we've got a 60% likelihood of winning. So we don't necessarily need to pick the best stocks. We just take the stocks that are slightly worse than average, and we tend to win with that strategy, especially if we think that the overall market over the next years is more likely going to go down than go up. We cannot time the market perfectly, but at least we can have the odds in our favor. It's all just a game of expected return. returns. It's all just a game of probability. If we bet our dollars on something and we've got a 60% likelihood of winning, and then maybe it's slightly higher because we think historically things are very expensive, maybe the probability is 66, maybe even 70% that we're winning, then I do think we should take that bet. And that was just for the example of the stock market. There is the crypto market where the skewness is even much more extreme. Have a look at these smaller altcoins over here. How many winners do we have? 1, 2, 3, 4, 5. And this is 100 bubbles that are shown over here. 95 out of 100 bubbles are in the negatives, and they are strongly in the negatives. More than 90% for some of them. And again, that happened while Bitcoin over the same time period only lost 10%. So this is really where the gains are hidden. It's not trying to jump on an asset that's already expensive, unless of course you've got a very tight stop loss and you just ride the momentum and then you exit very quickly once things turns around. That's something different. But when we look at the entire year of 2026, getting into something like gold is quite risky. Getting into stocks is also quite risky. Getting into silver is not that different compared to buying gold. And technology stocks are potentially the most riskiest of the bets. Sometimes it's better not to follow the hype. Sometimes it makes sense to be contrarian. And I do think that the contrarian bet is not to believe all of that AI buzz. I think the contrarian thinking here, and it tends to be the contrarian that makes money long term, right? The vast majority of people tend to underperform. A few minority outperforms. It's the contrarians that outperform. The contrarian thinking here is not to buy into the hype. The contrarian thinking is to do things most people do not feel comfortable with. And that's betting on falling prices, especially of the things that are very, very risky. It's very contrarian to think of shorting the market in a way that we've got the odds in our favor. Most people think, because assets tend to go up over the long term, that they really should only buy things for, say, an entirety of a year. Most people think that because money devalues over time, we should always just dollar cost average into something. But that's not necessarily true. The bear markets can be much more severe than most people think. This is the common narrative that everybody is selling. Buy the S&P 500 because it tends to go up over time. But this is mainly a reflection of the monetary base expanding. This is just the US dollar losing value. Because once we look at the S&P 500 relative to the money supply, the chart looks very, very different suddenly. Suddenly, it can take decades to get our money back. This here is 35 years of data. And the loss in purchasing power can be 74% over here or 73% over here. And does it really make sense to go risk on now given this long-term chart? I do not have a crystal ball, right? We could have made the exact same argument over here in the year 1997. And then stocks continued to go up for a bit longer. We had another 2.5 years of expansion and another 46% of rising prices. So really, it's hard to predict where things are going. But in general, if you just stayed loyal to your approaches, to seeing how expensive something really is, and you open occasionally a short position, you would have made quite nice money along the way. And that's currently my approach. There's a good chance that your portfolio unfortunately looks like this. There's a reason for that. The altcoin market got crushed this year. And it was all those influencers that get money from those projects to sell you those altcoins. That's why you are in losses. The fundamental problem is the conflict of interest. The influencers get money, they talk positively about a project, but they might not even invest in that project themselves. They maybe get a token allocation that they then afterwards sell. I've not seen a single influencer on YouTube that's actually willing to share their own data, that's willing to share how they are trading, how they are outperforming just buying and holding Bitcoin. Because obviously the vast majority of altcoins does not outperform Bitcoin. Now I try to be different on this channel. I don't just share my own data of my own trading. I'm getting into the ring, trade for the members of this channel, and everybody can participate. So in July of this year, we started a premium capital pool, and every annual subscriber of the community had the option to invest And while Bitcoin fell by almost 25%, we made 17% in gains. And it's not just the delta that I like, it's also the very low correlation. As in, when we went sideways, we made money. When we went down, we just lost a little bit. But in general, the strategy has very little correlation. It's very different to the general market where everything goes down, everything goes up at the same time. When prices are going up, it's not that hard to find winners. When prices are going down, it's much harder to generate profit. I want to share the data in a bit more detail. So the average depositor, by the way, we had several millions worth of deposits. The average member deposited 17.6K at the end of the 5-month period. That turned into 20.3K, so an average profit of 2.7K, which equates to 13.4%. Now, after a 10% fee, that ends up at 12%. Now, 13.4 is different to 17.3 that I showed over here. And that's because a lot of members first waited before depositing. They didn't enter on day one. They first wanted to see how some profit got generated. And because of that delayed exposure to that capital pool, the average return is lower compared to the return if you started on day one. But of course, the real number that matters more is the performance from the very beginning. If we then annualize this, we get to a value of 45% or 40% after fees. If you bought and held Bitcoin during that time, you lost. If you went into the capital pool, you won. If you measure your capital after that 5-month period in BTC, then you'd now have 1.51 BTC after fees. And so those are the kind of numbers I do not see any other influencer sharing, right? Most people just say, buy this token, or I called it right over here and I made it all correct over there. But really, when the rubber hits the road, when it's really about proving oneself against the market and potentially also showing this very transparently to a community, then very few people are willing to do this because it's hard to beat the market. It's much easier to just record videos, keep yapping, pretend to know everything. And while I'm not saying that I know everything, and while I do have bad trades as well, I am at least getting into the ring. I'm at least showing what I'm doing. I'm willing to share whatever success or failure I produce in the market. Now, this is just a test of 5 months. Here is my personal trading results over the last 5 years. So this is the monthly alpha over buying and holding Bitcoin. This averages out to 1.6% per month. The dotted line over here, that's the 12-month average. Had I just dollar cost average into Bitcoin, I would have gotten the return by this white gray line. But because of relative valuation trades, because we made money when everybody else was losing, we are able to outperform just buying and holding Bitcoin. That's the hard part, right? We always need a benchmark. When everything goes up and we just take on more risk by buying an altcoin, of course we can outperform. But if things go sideways, if things go down, that's where we can see who's actually swimming naked. When the tide is going down, that's when things get tough. So it seems like you're still around. Even after all of those losses, you still try to learn about crypto, and I applaud you for that. But probably if you haven't made any money in the last year, it's better to change gears. So you can simply just trade whatever I trade actively. So I'm sharing every single trade that I do in real time in premium. That's $125 per month. And because I'm having a good day, I'm sharing one trade here for free. That's actually a premium trade, which is Pudgy Penguins relative to Solana. So you're going short Pudgy Penguins, you go long Solana, and just trading this long-term trend. And if you're making money with that trade, feel free to reinvest this into premium if you don't want to make the jump yet. But Pengo is one of those highly inflating tokens, and it still has a lot of room to fall, especially if the market overall continues to suffer. But then, of course, if you don't want to do the active trading part, you can also join the next premium capital pool where the trades will be executed automatically. This time it will not just be 5 months, but 12 months of trading. There is the manual route. There are several tutorial videos on how to set up all those positions. It explains how to make money when Pudgy Penguins continues to fall, how to have proper risk management in place, and how to execute everything manually. But if you don't want to go the manual route, then instead of subscribing monthly, you can subscribe yearly. Now, currently this is still crossed on the website. This will get updated very soon. The next copy trading vault will launch in January of 2026. And so feel free to join. It's 10 months of premium, right? It's $1,250. You can also just start off with the monthly subscription and then switch over to yearly afterwards. But if you want to start out with yearly directly, again, if we are able to keep the current returns, which of course is a big if, right? Nobody knows if this rate of return will stay. But if this 5-month test is representative of what's going to happen in 2026, then the break-even point for premium with the $1,250 is an investment of roughly $3,000. So you don't necessarily have to go in with 17K, right? Once you go in with a bit over 3K, you already have all of that content for free. And it's not just tutorials, there's also premium updates. There's also various on-chain tools, etc., to help you improve your crypto game. If it's the very first time here, feel free to give this a like. It will help the channel grow. Feel free to also subscribe. I publish videos regularly. There's a link to premium popping up here on the screen. Just click on that. It will lead you to the website. See you next time on YouTube or see you on premium. Cheers.